Awesome.
Welcome everyone. I don't remember which episode this is. It's been a while since the podcast has done an episode. So I think Kenneth had, had really interesting things to share. Basically, right? He's, from my standpoint, as investing hustler, he would go get information, primary information from the company themselves, emailing and calling the CEO. And to get information. And Kenneth, for what I saw, like you invest in some REITs, right? And you actually focus on small caps, which is kind of interesting. It's not something that this channel has talked a lot about. So I'm happy to learn from you. So I guess the first question I want to ask you is that how do you where do you see your investing goals are?
Yeah, so my investment goals, it's changed a few times. The main one was focusing on high yield income stocks. So this be like down below, GOF, for example, GOF, Guggenheim Strategic Opportunity Fund, FCD.UN, Firm Capital Property Trust, as well as a few other small caps, pretty decent large funds for all of that. I'm still focusing on that, but I've also branched out a little bit in trying to go for div growth as well now.
Okay, so mostly income focused funds. What in particular drew you to that type of investment?
So the main way that drew me to that investment was when I first started, I didn't really know what I was doing. My friends were like, hey, invest in Tesla, buy NEO. So I then started looking around YouTube. I found a YouTube channel called Dividend Bull, Passive Income Investing, where we met in a Facebook group. Mm-hmm. And I just thought from there, I was like, I like the idea of getting money constantly. You reinvest it, it grows over time. You don't have to really do anything aside from that.
Right. So in terms of, in terms of like the passive income, you can either ask the company to return their earnings and cash flow to the investor, right? So then you invest that money, and obviously that has a compounding effect. Or a lot of times, the company says, we actually have good investment opportunities. So the company will do its own venture, right? And let the money compound. Of course, if you let the company do it, the money is a little bit outside your control. So that's one negative against not having the income. But a positive would be if you think about like all these, whether they pay distribution or dividends, all of these adds cost to the company. So then, if all you're doing is reinvest the dividends, like do you drip at all, or you try to invest in other things when you get a dividend?
Yeah, no, I manually drip a few of them. Like for example, GOF right now is way too big of a holding, so I take the dividends and I'll reinvest it on another fund or holding. Yeah,
right. So yeah, what do you think about the idea of doing your own reinvesting versus, if it's a company, there's a management you like, why not just let them invest it for you?
Well, the entire joy of dividends, at least for that, is that the main thing is that I watched a YouTube video on it. Basically, it's like a bribe for you pretty much to stay on. Now, the reason why it's better to give to you is that then you can turn around, buy shares using drip. They give you the chance to do it. Mm-hmm. Basically giving the dividends back to the company. Now, the other thing is that management, yes, they can use it. They can pay down debt. They can do all this other stuff with rather than paying a dividend. But some companies just won't attract investors if they do that. I talked to Decisive Dividend Corporation a while ago. They're a small industrial company in Kelowna, Canada. And I asked them that. I was like, you're extremely small. You barely make enough money to pay the dividend and pay down your debt. Why? And their answer was, well, no one would ever buy our company if we did that. We're a Canadian industrial company. No one really cares about us. Mm-hmm. So it's also appealing for people to just bring in like more investors, get a super loyal following. So it honestly, it benefits the investor more than the company, but some companies, just from what I've at least talked to, have basically said we have to do this, or we're just like, our stock price will be $1 and never grow.
they have to get on the radar. It's like a cost you
Yes,
have to
that would be
pay
the
to
answer.
participate in the capital markets. Yeah, so that's interesting.
Exactly.
And it's
Yeah.
a bit of a shame that the companies are forced to do that, but it's extremely interesting, to hear that perspective, especially that, like I said, you contact these companies directly and get information. So that's wonderful to learn. So let's talk about your investment goals together with your life goals, right? Like if I learned you're fairly young, you're 24. When I was 24, I wasn't investing that much. So you got some pretty big head start. But you're going back to school, and what do you see your kind of investment doing for you in 2, 5, and 10 years?
So in 2 years, I don't really see much of anything. A few of my dividend growth positions will grow, decent amount. Income will probably stay the same. I'll probably keep putting my own cash in it. 5 years, I'll probably see a pretty good return. Goff, CLM, Cornerstone Strategic Value Fund, I should see hopefully at least like a 50% gain just via dividends by that point. 10 years, I'm hoping my goal is to at least almost double my entire investment value. But the fact is, I don't think I'm going to get there because I changed more to dividend growth, but small chance I will hit that.
So yeah, I was thinking more along, yes, like, ultimate goal is obviously to grow the wealth, right? But, there's a couple of points in my life I had to draw down my investments. One was, so I started investing when I was in high school, but just a couple of $1,000s. It wasn't that big, but I had to draw down that when I was doing university, how to pay tuition. And then I started investing after I started, working, but I ended up doing a PhD 3 years after I worked. So obviously I stopped investing after that. Like it wasn't, I didn't have any more disposable income to put in the investments, right? But I wasn't, I didn't sell any. So, and then I draw down my investments to pay for a down payment when I finish my degree. So in life, I guess, there's certain points, even though we're young, like you need money, right? And does that factor into your decision at all, like whether to go for a more income focused strategy or for a more growth focused strategy? Because I understand that's one of your questions, right? Is why you're trying to figure out for yourself which way to lean.
Yeah, so as of right now, so I actually did that for my wedding. Funny enough, I put a huge chunk of my portfolio into a purpose enhanced premium yield, ticker's PAYF. I put a whole ton of money in it, like $3,000. I left it in there because, hey, it's risk managed. There's no leverage. It's probably one of the safer and giant quotations that you could pick in this type of market. So I picked that specifically because, like, if I need my cash, it's right there. Right now, I don't have that, but a few of my funds, I'm like, if I ever need cash down the line, hey, I can take it. It shouldn't be that big of an issue. Again, Goss mostly bonds, firm capital hasn't really fluctuated that much. It's only down about $1 since I bought it.
Well, that's like
So needing
15%.
cash,
a dollar out of like
concern.
$8, right? So that's
sorry.
Well, $1 out of $8. It's
yeah,
15%.
true. It's
not like the
it,
NASDAQ.
It is 15%. So the thing is, it's oh yeah, no. Like for example, like down 15%, and I'm like, yeah, like down 15 sounds like quite a lot. But then you have people, for example, like, hey, I invested in. I'm trying to think of a good example, like Tattooed Chef, it's down 70%. I invested in Orc, it's down 45, 50%. So even again, it is down quite a decent amount. And if I do need cash, I realize I'm taking a pretty heavy loss, but it's still better than being like, oh, hey, I don't know, let's say put $1,000 in it. I'm only down like, I don't know what that would be really, like $10 compared to, hey, I've lost 40% of it, $40 or so on. So again, like, yeah, it does. That math's completely wrong there. so yeah, it does bite a bit, but at the same time, like there's ways like, try to have cash on the side. Like I'm still working part-time while I go to school to try to build a cash reserve if I ever need
Yeah.
anything. I have, a few stuff to sell, laptop. I have 3 phones, probably sell one of those, but investing, it's like, if I have to sell it, I'll probably pick the one that I'm confident I can probably get back in at the same or cheaper price.
Yeah.
And that's fluctuated the least amount.
Yeah, I think that sounds great. I mean, you have a selection of higher or lower beta stocks, right? And at any given time, if you need emergency funds, or you just you need to pay for a wedding, pay for things that you really want, which I think it's it's underemphasized. Like how do we live, right, while we're trying to maximize the investment returns? Like a lot of people are just so gung ho and kind of squeezing every penny out, but you're not living. And that's not healthy. But if you can, if you're relatively sure, when you need to sell, you won't be forced to sell at a loss, right? And then when you want to buy back in, maybe the market's already kind of risen. So it seems like you have you have kind of the strategy. Now, I just want to share something with you. It's not necessary to teach, although like my inclination is to teach because that's my profession. But I want to share this with you and just want to kind of like get your reaction to it, right? Let's see if I. So let's see. Share screen. Okay. So is the screen changing?
Yeah,
Can you see
changed.
the PowerPoint? Okay, so
yeah.
So this is, you had the question about income versus growth, but I think for most people, they have to think about these 3 things, right? Whether they have disposable income, for every investor we have at certain stages, we just don't have the disposable income. Then you just stop, right? And then managing financial needs, more like kind of, you have to chart out your timeline of when you need money, right? And just making sure, like you said, the money is there, or the investment that you hold at the moment is not very volatile that would be forced to sell at loss. That's why retirees, people say retirees should hold 40 or 60% bonds, not because those will give you longer higher returns in the long run, but like they need to constantly draw down that capital, and who knows, right? Like right now we're in the stock market bear market, and if they don't have any bonds to sell, that's a very, very rough situation. And then the last one, it's not crucial. Like people can always diversify and just buy ETFs, index funds, but there's identifying valuable investments. And I think today, I want particularly focused talk with you regarding REITs. We'll talk about that. So it's about managing all 3 of these to have a successful kind of investing career. So this is what I want to share with you. So that, okay, so instead of just looking at growth versus income, where really it's more like a quadrant to me, where you have on one of the dimensions is growth versus income. Basically, growth just means that the money is not returned to you as the investor, and the income is that you get the money back, consistently. But there's also high versus low volatility investments, right? So the things you just described, we'll talk about bonds because that's more related to interest rates, and it pays, interest monthly. It gives you income and it has a low volatility because the bond price doesn't fluctuate that much, except when the Fed raises rates, of course. And then you have some funds that use strategies, right, options to purposely reduce that volatility. Like, for example, NUC or PayF, because they hold, they sell call options. They also hold put options, so that when the market falls and the put option value goes up, then the overall position has now changed. Excuse me. Yeah, it's my dog. So you could go this route, or you could just go say, hey, I don't need money consistently. Then I can invest in individual stocks like Apple or Google. These are great companies. They pay little or no dividend, but their earnings is growing at a higher rate, right? For example, they could be paying 2% dividend on their stock, but or 1%, right? But their earnings is growing, 20, 30% a year. Then eventually you want to see that being realized into a higher dividend or capital growth.
Finding out investments this way, like I've seen Apple, Microsoft, Google a few times in like other people's portfolios. Yeah, that pays no or little dividend. That's very true. Individual stocks with high revenue growth, lower negative earnings. Yeah, I actually haven't seen Apple or Google hit like negative earnings in like pretty much forever.
Well, at the beginning, right? At the beginning. So
yeah,
that's the thing. Like you have these more blue chip growth stocks and you have more speculative stocks, right? And the trick is obviously when will those become have positive earnings or lower their bankruptcy risk. But I would just group them in the same in the same bucket. Now let's just assume they will grow, but it's not necessarily true. So from the investor standpoint, we know that volatility and return tend to be positively correlated, right? So
yeah,
investors get paid to hold more volatile stocks for enduring that risk, and hopefully they get they have a payoff at the end of it. But at the same time, volatility is one thing, but the risk of total loss is the company going bankrupt, right? They have a bad business model, and then they are over leveraged, and that basically just wipes out your investment. So that's true too. Now it's difficult to separate the companies that's just have a bad patch, or just got unlucky, or just have very, very volatile stock price, versus those were just basically bad investments, right? So for some people, just they say, oh, okay, I'm going to stay away from the volatile stocks altogether because I just want to avoid the bad investments.
Which is a fair thing to have. Like it is very true. Like for example, like FCD is like over 100% payout ratio, so they're paying more than 100% of their income just via dividends. So they can't pay down debt, they can't use it to buy property. Compared to like Microsoft, Apple, Google, it has whole tons of cash. They probably have massive cash reserves. I haven't looked at their income statement or Q1 reports, but it is very true. Like if you pick a bad investment as a high yield, so like for example, Orchard Capital, it's slashed the dividend twice. They're constantly losing cash. Like there is a very good chance you can pick a bad income play, lose a whole ton of money, and goes bankrupt. Like everything you said is very true.
Well, I guess
covered call.
I didn't mean to say bad investments as in the right sides could be more bad. Like it's just like that's another way to think about things. So like volatility is one thing, but the quality of the investment, it's something else. So I didn't mean to say, oh, like we have more bad investments among the high payers, right? Like there could be bad investments in any four of those quadrants, right?
Yeah, it's just more, but the more commonly where they're found is on the right side, because normally companies will pay an insane huge dividend to lure in investors and be like, oh hey guys, surprise, we're actually losing money.
Or they could be growing at all costs, right? And
exactly,
overextending themselves and
end
up running into trouble.
Covered call funds, I rarely see it. It's more companies like REITs. REITs, I haven't seen any bankruptcy yet, but I've seen quite a few slowly start losing a whole ton of cash very recently. Preferred stock, normally they're backed by a pretty solid company or fund manager, so it's pretty hard to see those go anywhere. But again, like I agree with you, like we're not targeting the income side. I mean, I'm all for it, but at the same time, you'll mostly find those companies in the right side of the income over growth. Like growth you might find once in a while, but it's way less common.
But one thing is that we know, but I'm not sure everyone knows, is that okay, just because they pay a dividend doesn't mean they have good cash flows, right? Well, those cash come from somewhere, and sometimes like you said, firms would actually borrow to pay dividend. Let's just put them in a bigger hole, right? Because next time they have more interest to pay, plus the dividend. So that, but there's also some companies that don't have any positive cash flow to begin with, right? And those are extremely risky. As for funds, obviously we look at funds and stocks differently, but funds just a basket of stocks, right? So if the funds consist of a lot of risky investments, bad investments, then the fund's not going to do well. The reason I put in the income is that instead of letting the stock price just kind of grow, and because the company is growing and the compounding over time, the covered call funds kind of extract that income out, right, from month to month, or some are 4 times a year, and return that money to you. But in return, you're giving up some of that capital gain, right? So because of the covered call strategy they use. So there's a market and for these type of products, some people just prefer to say, well, I don't need the money on a month-to-month basis, and I'll just go for some growth stocks. But you're kind of unique, right? Like, I don't think you need money more. You don't need the money in the next little while. You're not looking for a constant pay, but you just enjoy the process of kind of receiving these dividends and reinvesting them.
Oh, 100%. And on the growth side, the main reason why I stay away from it is because, yes, all the earnings, everything goes back into it, but what if the company, tanks like a huge amount? Like, for example, Tesla, it's all the way down to $600 now. It used to be at like what, 1,500. So the entire time,
1,200,
like the entire time it's declining. You're not getting anything from it. You're just losing cash. There's no quarterly payout. There's no dividend. There's no special. So obviously you're holding it because you believe in the company, and obviously it will probably grow back. But as of right now, where you're watching it decline, there's nothing to help you sort of be confident, or that little
So that gets into the investor psychology side of things. So I don't tend to think this thing that's the volatility, right? So the volatility you can use to your advantage or not. Like if you're a long-term holder, you're not looking at the stock price 1 or 2 years, then you can hold through the volatility. But let's say you try to extract income from it. Okay, so you hold a stock like Tesla. There's nothing preventing you from selling at 1,200. Why didn't you, right? So you could. If you had that, you just have to identify the opportunity to do it, or you could sell your own covered call options on the stock. So there's nothing wrong with holding growth stocks, but it is whatever that makes you comfortable, right? And say, okay, if you tend to think of that, the stock price dropping from 1,200 to 600 as a loss of $600. Then I guess someone like that would be miserable, right? Thinking of what could have been, right? But you could also have sold. Let's say your cost base is 600. You could have sold for 100% gain, right? At 1,200. True. So that provides an opportunity to you. Now for some income focused investments, you're never going to get an opportunity, right? So it's just a matter of
very rarely.
So you're not forced to sell at a low price, right? Because you always have the option of selling at a high price. It's just whether or not you want to do it. But it's for investing in growth stocks with high volatility, it means that you need to have the discipline and also the financial stability to not be forced to sell at a low price.
True. But then at the same time, I go in probably a bad way to look at it, but you go into the Tesla chat rooms and it's $1,500 stock easily, and then you watch it and it climbs,
mm-hmm.
Then it starts going down, and everyone's trying to hype each other up, guys, buying opportunity, and it keeps declining, and eventually your average is way up here,
mm-hmm.
and then you're going to be selling at a loss.
There's nothing forcing people to sell unless they are overextended, right? I know a lot of people buy Tesla on margin, and that's not a smart strategy, right? Because you can be forced to sell through margin calls. In the end, it becomes over the very long term, it all depends on whether the company is doing well or not, right? If you hold firm capital, are they making smart investment decisions with respect to the properties? Like for example, we can talk about this FCD a little bit. It's a unique REIT in that like it has industrial, residential, and commercial property, right? That's was one thing that drew me in. And also like it wasn't that well known. I should just disclose, I guess, Kenneth and I both hold FCD. And I think he has something to do with it. And on the residential side, unlike these REITs that hold apartment, like people would say, the Canadian apartment REIT, right? Like that's a big one. But they hold assets as these manufactured homes. So like a small subdivision, they just rent them out, like rather than these big apartment blocks. So I think the people who live in the manufactured homes are less likely to have turnover than the usual apartment crowd, so potentially there's more ability to raise prices when you need to. So anyway, that's just it's a interesting investment, but in the end, it really depends on the Canadian real estate market, as well as the management acumen in selecting the right properties, right? So the next thing I guess I want to do is so why REITs? We talk about FCD. Why REITs? Why would an investment like REIT fit someone in the investor profile like you? That's my question.
So the reason it fits an investment profile like me among many other people that invest in REITs is because it's a cheaper way of owning property rather than like, hey, I need to buy a down payment, I'm gonna have a mortgage. It's a cheaper way to basically hit that market. On top of that, you do nothing and the REIT will pay you. So in the US, like for example, Realty Income, they believe there's a law, or not even a law in place, but they get a tax benefit for paying you a substantial amount of their income via dividend. I was gonna say, please research that.
It's more a distribution.
Distribution for REITs.
Because it's income. It's known as the income trust. They're not like a corporation, right? So they if they pay out the money to unit holders, then they don't have to pay tax on corporate income, and corporate income in the States is high. In Canada, it's also high, but not as much. Actually, I think I date myself. Before the Trump tax cut, to the States was higher, but I think it's more level, maybe even a bit lower than Canada. So you have these the tax benefit. Now, once you receive the money, you still have to pay tax as the shareholder, but there's a trick around it, right? You can invest it in a vehicle like TFSA, or it's a pension fund that holds it, and the pension funds are exempt from tax, the same thing as the TFSA. These money are not taxed until the pensioner receive it, right? So you have like tax-free at the corporate level, and then tax-free at the investment, at the broker level, individual level. So it is very attractive. So that is the basic REIT advantage, I suppose. But they don't grow a lot, right? Or do you think that you actually, you're trying to capture income and growth as well?
So for most of them, you're trying to. Something, for example, like Realty Income has not grown in years. It's still in the 60 range. It hasn't grown very much. Firm Capital grew a solid amount. Another REIT that I think you and me probably both know, Nexus Real Estate, NXR.
I don't have that one.
Yeah, I don't have that one either, but when that one launched, I remember our group that we both were in a while ago talked about it, and it exploded from, I think it was like, I might be wrong, $8-9 to like 12 or something pretty quickly. But that's the thing, like some REITs will have quick growth for any really reason, but then it's always normally a decline, just float. So it's a good place to put if you want dividend income.
Yeah.
Growth wise, again, you're probably not going to get very much of it. In some occasions, you might get a massive spike, but those are normally not long lived at
As
all.
what happened in Canada and the States for the industrial REITs, right? Those just took off.
Oh yeah, yeah.
Which then what have risen high and is fallen back down to earth. Things like Summit, SMU, Granite, which is kind of weird one, right? Granite is mostly just Magna. That's 70% of their business is Magna. So you're tying your fortunes to a single company. And the one I hold, but also got crushed is the Dream Industrial. Not sure exactly why. They have some exposure to Europe, and I know the European market isn't so good. But okay, so can we go back to your thesis of like investing in REITs? Like, is it just REITs you like in general, or is this just very particular a few that you like, and otherwise you don't think REITs fits your goals?
Just a few in particular. So a few of them, basically, how stable is the income? Have they cut it anytime? If they did, for what reason? What's the payout ratio? Is earnings and dividend growing? So, like Dream, I don't think they've increased their dividend for quite a while, have they?
I don't think so. At least not while I've owned it.
Yeah, so like there's some REITs that are just pure income plays. They're well aware of that. BTB/UN, it's like a penny stock REIT, just crossed over like $1 billion in assets. But it's like they are never going to raise their dividend. They're pure income, so that's great for half of it. The other half is I want my income as well as growth. I've pretty much reached where I want now. I have realty income. I have ADC, Agree corporate, Agree like real estate. I have firm capital. I have net, NET/UN. I have pretty much that's it for my REITs. But like I have more than enough because it gives me my income, firm capital, gives me growth.
Yeah, and you're saying these distributions. Which account do you hold it? TFSA?
All of them in my TFSA, yeah. So I have to eat that minus 15%. Yeah.
Oh yeah, if it's in the US,
the withholding tax.
Yeah,
like
if it's Canada, then you're set. So okay, so that's something I want to kind of pick your brains on, since you're such a REITs guy. I've broken up some performance metrics, right? So I track these. I think all of these are important. I'm not sure which one is, what weight, right? Like, for example, if you're looking at trying to calculate the overall score, where to place the most heavy emphasis. Okay, so I'll just take a look at these. I'm sure you understand these terms, so I don't have to explain what EV, which just means enterprise value. So which metrics would you place the most emphasis on? And if it's not there, if it's not in this list, that's fine. You can tell me where you look.
Yeah, the very first one is debt to gross property, because if they get they are going to go bankrupt or whatever, you want to make sure that's all covered.
How often does that happen?
Not very often, but it's more just to have it at the off chance. Like, for example, like firm, I think I forget what it was, but there was a REIT I was looking at
51%.
Yeah, 51%. Like that's fine. Like if it starts exceeding 100%, then it's something to seriously worry, because like why are they taking on so much debt?
Yeah, let me show you something.
Or
let me show you something. Can you see this? Can you see the list? So now these are some of from Q3 2021, so I've yet to update them. But the debt to property percentage, what's the average? About 54%. Yeah, so 51% is not that outlandish, and then if you can pick, lower leverage ones. What do you suppose is driving these differences?
buying property, because half of them have to take on debt to do it, or they'll try to issue shares.
Yeah.
Normally issuing shares, or at least what I've seen, because Firm Capital just did one, it wasn't enough to pay for the property, so they have to go into debt or find a different way to do it. So normally it's buying properties increases the amount of debt they have.
Yeah. But I understand that. When you're buying property, you're just like an individual, right? You have the option to finance it through equity or debt. Why do you suppose some, like, what is this? SGR. So this is Slate Grocery. No, actually, no. SMU. Okay, so this is Summit. Okay.
Industrial, yeah.
So they've explicitly not choose to finance through debt, where others are pretty leveraged, right? Like SOT.
On here,
I understand there's a risk in terms of bankruptcy if indeed they have interest to pay, but I think for REITs, it generally is not such a big concern because, for example, you have a software company. If you're into cash flow issues and nobody wants to buy your software, you're screwed, right? It's just you can just die. But here, like, you have numerous properties, you can always choose to liquidate a property to avoid going bankrupt. So here we see firms going in kind of different directions in terms of leverage. And I assume, right, the more leveraged firms would actually provide you a higher return on equity, just like what we do, right? If you buy a house 100% cash versus you buy a house 80% mortgage, 20% cash, your return on equity, if the price of the house goes up, is going to be much higher if you leverage.
Yeah. Wait, I believe it's also the market. Because, like, how's Summit doing price wise? Are they holding up pretty well, or have they also?
I don't think so. I mean, you're probably right in that they may have taken advantage of high stock price, and just issued more units and bought property that way instead of instead of leveraging up, right? That's one way to do it. So, like, if it's over 70%,
even 70 is not that bad. It'd be like once you're pushing 90, then you should start to really worry.
Well, 90%. Okay, yeah, that's a
yeah. Then
I mean, I look at this like,
panic.
If you're a first-time home buyer, likely it's going to finance 75 or 80%, right? So like, it wouldn't. I think you have to think about this in conjunction with their FFO, return on equity, right? So are they generating good returns from that leverage, right? So FFO just means funds from operations. The reason why we look at that for REIT investment instead of net income is net income includes the change in fair value of the property. Now, if they don't sell the property, that's not cash, right? And that's not something that's you can immediately use. And plus, it's not like a single house or apartment that's you can say, oh, the price of this went up. What if you have an office building that's in a unique location? So you may not have just because they say the value went up, they may not be able to sell at that value because the value is calculated with future rents and cap rates and stuff. So FFO just removes the changes in fair value. I think AFFO goes a step further. They remove even the rents they collected on the property that they were going to sell. So so that's like a more stable, right? But obviously, I think it's a little bit more conservative than FFO. But both are kind of better metrics in terms of calculating returns on asset. So if they have higher FFO returns, I suppose that give them a pass, right? In terms of having a high debt level.
Yeah.
And I tend to look at it as like, okay, so you have the FFO now, but what about down the road, right? So if you think we're going to head into a recession, maybe the occupancy will drop, and it becomes like, okay, so how much of the FFO is used to pay for everything, interest and the distribution? And what are the chances the distribution will be cut, right? So because we pretty much know if the distribution is cut, then the price of the shares would go down because most people when they buy REITs, they're looking at that monthly distribution.
Yeah.
So coming back to the spreadsheet, so this is something that, I wonder if you agree with me, is that I calculate this trade premium. It's basically, I take the fair value of the net asset, the net property assets, and compare it to their enterprise value. So it's basically management estimates of how much the properties are worth and versus what the market thinks they are, right? So to the extent that there's a negative number, means they're undervalued. And I'm willing to kind of take a bigger risk buying a position, thinking that might reverse. Do you think that's any value at all?
It could be at the same time. It could be, and like a lot of people will probably look at it like that. I more look at, is it more sustainable? I don't really care too much if it trades at a premium unless it's something insane. Like 17's a decent amount, but I think it's more based on holdings, management, distribution, history, occupancy. Like, how has Inno's occupancy been?
Well, yeah, so you're right. So these negative, so these discounts you see in the market is typically related with low occupancy. So yeah, so in Novelist, which is kind of like I had to pick, I want a one office REIT. It was the choice between Novelist and SOT. I picked SOT because SOT had a much bigger margin. Just kind of like this, even if their FFO falls, they can maintain their distribution where Novelist could not. Right, so that's my decision not to go with Innovalis, although they both look undervalued at that point. In SOT, even less so.
The other thing, it might just be a me thing, but the other thing too is that the yield for INO is, or sorry, no, it's AFFO return is
the yield, I think, let me go to the front.
Yeah,
you're talking about the distribution. Yeah, the yield is 10%. Yeah, I don't know if they cut it again. I haven't
yield
updated since
really
November 2021. So the annualized yield is like 11% right now because the price is falling so much. Yeah, I think when we're looking at it, I sold this one. I used to own both. I sold it at around $9.50.
Oh, so it's dropped since you've sold it then?
Oh yeah, big time. Yeah.
Where
SOT has held up fairly well. So I was investing this at $5, and I had them, I bought I know anywhere between $9 and $10. So I ended up setting at $9.50, pretty much a wash. Like except for the dividends, I didn't make any money on it.
Yeah. The issue is trying to point this out is that every investor is different. Some just go for the yield, some just goes for that. But yeah, I don't think it really corresponds because like it's so random too. Like as you said, like that, like Inno's so undervalued right now, minus 17%. Like why isn't it getting bought up compared to all the other ones?
At that time, Innovalis wasn't even like their cash there's no way they cover their distribution. The only reason distribution was so high because they sold several properties. But they were saying that because of their as the economy recovers for office in Europe, their rents will go up, and then they would be able to cover the distribution without having to sell any additional properties, which I didn't really think that was going to happen. So that's why I sold too. Yeah, so it is quite. If people are unsure about REITs, I mean, each individual one, just like a stock, you could have good management, bad property. They could buy something like Realty Income Corp, which is huge, right? Very well diversified.
And
or you can buy a REIT fund. You would tend to go for kind of sustainability, right? Like that's why you were concerned about FCD's coverage, exceeding 100% FFO.
Yeah, debt, then AFFO, and then occupancy and everything. But yeah, the AFFO is
Occupancy was
now
fine, right? Like a 90,
occupancy is fine.
97.
Oh yeah. Oh
Yeah.
yeah. Yeah. No, no. Like
That also
they're
means
doing
that they
great.
just, even if they hit the 100, it's not going to raise their FFO all that much. But you did say you like management. Why did you say that?
Oh, I love the management. So I had a one-on-one call with the CEO, Bob McKee, and the management. The one thing that stood out is that if the REIT, for any reason, cannot pay for a property, then the board members will step in, put their own cash on the line, buy the rest of the property. So if you ever go to Firm Capital's, basically like properties they own, they'll have like percent ownage, or how much
Mhm.
they own the REIT. If it's anything below 100, a board member owns the other percent.
I see. Okay.
So that's the biggest thing, is that instead of normally, you want to say, hey, how big is the insider, like how many insiders hold shares in the company, they're literally going out of their way and doing a step further and buying the rest of that property. And now they're, if the REIT collapses, all their property collapses, and that's most of their income. So
why would the property collapse if the REIT collapses? I mean, I tend to see them as a different issues.
It'd be different issues, but it'd be like, for example, like if the REIT goes bankrupt, now you have to buy out the other 50%. What if you don't have the cash? Like you have to go look for someone to help.
Okay,
you.
if it's forced to sell the properties at a loss, I guess then the manager is on the hook for that too. So the interest is aligned.
Yeah.
Okay, so it's good to know that it's company specific knowledge. Is there anything else that stands out about Firm Capital?
That's pretty much it. They also, the CEO, said that the dividend is sustainable until it exceeds like 150% for more than 2 years. Then they'll have to do something drastic.
Well, it's because they're cash on hand.
Cash on hand, yeah.
Or they have like already planned some sales. Yeah.
Like probably they said their last thing they're going to do is cut the dividend, because that's mostly what people, including myself, found them and researched them and bought them for.
Right.
But if they had to cut it, like I think they know like a lot of people would start bailing pretty quickly.
So in addition to owning the property, part of the properties that the REIT doesn't completely own, are management large unit holders of the REIT itself?
Not that big. No, I want to say something maybe like, I think last I talked to him, it was 4%, but they just did a big issuing of shares. So I don't know how that's affected their percentage.
Well, okay. I mean, yeah, I don't know if that's normal. I haven't actually looked into it. I mean, if they're not it's like, unless they started with a whole bunch of money, right? It's not like a tech company that it start from nothing, and this company can 1,000, but it can also die like this. But for real estate, you pretty much have to accumulate capital, through more debt, and buy companies. It would be rare to see like the CEO own like 10% of the company, right? Because he would have had, he or she would have put in a lot of money in. But I think 4% is not inconsequential, I'd say. In terms of the offerings, I hope they will just buy some along with the rest of us, just to show the commitment.
Just to show it,
yeah. Anything else you want to discuss about REITs that we didn't mention?
Pretty much everything right there. The AFFO, occupancy are both important. Debt, net property value. Yeah, you pretty much have everything, pretty much that like right here on the screen.